Welcome to the Explainer. Look, if you've been keeping an eye on the regional banking sector lately, you already know it is an environment where only the most well-capitalized players are truly thriving. Well, today we're looking at a serious standout, the PNC Financial Services Group. They just dropped their first quarter numbers for 2026, and honestly, the results are turning heads across the market. Okay, let's dive into this, because PNC is making some strategic moves right now that absolutely deserve a closer look.
I want to hook your attention right out of the gate with this number, 18%. That is the massive, eye-catching quarterly dividend hike that PNC just announced. Think about it. In a complex, totally unpredictable macroeconomic environment, a double-digit percentage increase like that is a huge signal to the market. But it begs an immediate question, right? How exactly did they afford this? How is a bank increasing its payout by nearly a fifth while so many others are just playing defense?
To start answering that, let's gauge the tone from the very top. Here's what CEO Bill Demchak had to say in the Q1 release. 2026 is off to a great start for PNC. Client activity remains robust across all our geographies, and importantly, we're well-positioned to continue our strong momentum. That is peak executive confidence, but, talk is cheap. In this explainer, we're going to look straight under the hood at the hard data to see exactly what backs up that level of confidence.
So here is our roadmap. Number 1, the 18% dividend hike. 2, Q1 2026 earnings breakdown. 3, the FirstBank acquisition. 4, passing the stress test. And 5, macro risks and outlook. Let's jump right into section 1, the 18% dividend hike.
The new quarterly cash dividend on common stock has officially been raised to a clean $2 per share. That is up an impressive 30 cents from the previous quarter's payout of $1.70. And you have to understand, when a bank authorizes a hike like this, they aren't just looking at the past quarter. They are telegraphing total, absolute confidence in their forward-looking cash flows.
In Q1 of 2026 alone, PNC returned a staggering $1.4 billion to its shareholders. And they balanced this out perfectly, splitting it right down the middle, with $700 million in common stock dividends and $700 million in share repurchases. That new $2 dividend? It gives PNC a robust 2.7% dividend yield, which comfortably beats the industry average of just 1.7%. And with a payout ratio of just 39%, they're safely balancing these consistent returns with the need to actually reinvest back into their own business.
Moving on to Section 2, the Q1 2026 earnings breakdown. Right off the press release, we hit the headline figure here, $1.8 billion in net income for the first quarter. If you look at earnings per share, that translates to $4.13 in diluted EPS, or a very healthy $4.32 on an adjusted basis.
Now, when we compare Q1 2026 to the previous quarter, you can really see the dynamic shifting. Total revenue ticked up 2% to $6.16 billion. But look closely at the components here. Notice that net interest income jumped a solid 6% to $3.96 billion. This jump was absolutely vital for them because it successfully offset a slight drop in non-interest income, which fell from $2.34 billion down to $2.20 billion.
So net interest income clearly did the heavy lifting at nearly $4 billion. Meanwhile, that slight dip on the non-interest side, that $2.2 billion piece of the pie you're seeing, was primarily due to a $31 million decline in the valuation of mortgage servicing rights. If you're not familiar, mortgage servicing rights are basically the fees a bank collects for processing mortgage payments. It's a highly interest rate sensitive line item, so this dip was driven by rate volatility during the quarter rather than any sort of fundamental flaw in their core fee-generating businesses.
To really appreciate that 6% jump in net interest income, we need to talk about NIM, or net interest margin. As a quick reminder, this is essentially the lifeblood metric for any bank. It's simply the difference between the interest income a bank earns on the loans it issues and the interest it has to pay out on the deposits it holds. In Q1, PNC's NIM increased by 11 basis points to an incredibly impressive 2.95%. Why? Well, because they managed to actively lower their funding costs, seeing an 18 basis point decline in the rates they had to pay out on interest-bearing deposits. Honestly, it's a masterclass in margin management.
Let's shift gears to Section 3, the FirstBank acquisition. The immediate balance sheet impact of this deal was just massive. Average loans increased by a staggering $23 billion, or 7%. Now, while they definitely did see strong organic commercial loan growth, a huge chunk of that volume was driven directly by the loans acquired from FirstBank. Just look at the sheer size of what they bolted onto the company when this closed on January 5th. FirstBank brought $26 billion in total assets, $16 billion in loans, and $23 billion in deposits. Of course, integrating a bank of this size isn't exactly free. PNC took a temporary hit to their non-interest expenses, incurring about $98 million in pre-tax integration costs right away in Q1. They expect the total bill for integration to eventually reach $325 million. But, when you look at the assets acquired, it's a price well worth paying.
Because perhaps the single most important benefit of the FirstBank deal is the liquidity. FirstBank drove an $18.8 billion increase in average deposits. In modern banking, sticky consumer and commercial deposits are absolute gold. This massive influx is what allowed PNC to rely a lot less on more expensive wholesale funding, which directly contributed to that beautiful net interest margin expansion we talked about a minute ago.
Section 4. Passing the stress test.
The absolute most crucial metric here is the Common Equity Tier 1, or CET1 ratio. It's essentially the bank's core equity capital compared to its total risk-weighted assets. The regulatory minimum required for PNC is 7.0%. As of Q1 2026, PNC sits at an incredibly comfortable 10.1%. They aren't just clearing the regulatory bar, they are soaring right over it. This buffer acts as a massive rainy day fund.
Under the Federal Reserve's hypothetical severely adverse scenario, which is basically an economic doomsday simulation, PNC's CET1 depletion was a microscopic 0.3%. Let that sink in. That was literally the best performance in their entire peer group. Because of this, their stress capital buffer, which is the extra capital the Fed requires them to hold, remains at the bare minimum of 2.5%. And their liquidity coverage ratio, measuring their ability to survive a short-term cash crunch, sits at a highly secure 107%. That tiny 0.3% depletion in a doomsday scenario, that is exactly what gave the board the mathematical confidence to greenlight that massive 18% dividend hike we started this whole explainer with.
Which brings us to our final section, 5. Macro risks and outlook.
Obviously, PNC isn't operating in a vacuum, and they clearly laid out their baseline forecast and the headwinds they're closely monitoring. Their baseline assumption right now is that the Federal Reserve will hold the Fed funds rate steady, somewhere between 3.50% and 3.75% through 2026 and into 2027. But they see two-sided risks here. On one side, if inflation proves stubborn, or if geopolitical conflicts, like tensions with Iran, cause major market shocks, the Fed might actually be forced to hike rates again. On the flip side, if the economy falters and a sudden recession emerges, we could see deep and prolonged monetary easing, which would absolutely compress that net interest margin they've worked so hard to build up.
Which leaves us with his final thought. We've seen the 18% dividend hike, the margin expansion, the successful onboarding of FirstBank's massive deposit base, and quite literally, the best stress test performance in its peer group. The macro environment is undeniably uncertain, for sure. But with a 2.7% yield and an ironclad balance sheet, is PNC perfectly positioned to outperform its peers through the rest of the year? Keep a close eye on those interest rates and loan volumes next quarter to find out. Thanks for joining me for this explainer, and keep learning.